Welcome, everybody, to Lyle Center for Berkeley Law's Entrepreneurship and Law Workshop Series, where we tell you what you need to know, trying to get your business started, trying to get you out on the road safe as a business. Many things you need to know about the law, and what we try and do is boil it down for you in about 15 minutes. You know, what you need to know about a particular area of the law. And today we're going to be getting to capital land, trying to introduce you to a number of the capital documents that entrepreneurs tend to need to set up with their funders, okay? So what we're going to do is we're going to have a 15-minute overview of this called Visiting Capital Land, Getting to Capital Land. And then we'll be followed by lots of question and answers. Time for you to ask specific questions. And I should point out here over on the side, we have the PowerPoint printed out, but we also have the individual documents that we'll be talking about, the SAFE agreement, the KISS agreement, restricted stock agreements, and Kevin will be going through all of those in just a moment. So thank you for coming, and we'll get started. Kevin.
Thank you. Hello there. My name is Kevin Shu, and I'm here to help make you smarter and safer travelers on your journey to Capital Land. You've all heard of it, that genuine, one-of-a-kind adventure that will take you all the way from the crystal blue waters of auction pools up to the dividends of the earth. And so hold on to your valuation caps and sit back and relax as I take you through just some of the sites that you'll see on your journey. Now, first, I'd like to go through a kind of a roadmap of what you might expect during one of these trips. Now, often, kind of the first type of outside investment you would receive is the convertible note or some other flavor of convertible security, such as a SAFE agreement or a KISS agreement. We can dive a little more deeply into each of those later on. Following that, you probably have a few venture capital rounds. It might be a Series A, Series B, Series C. And then finally, you go into an IPO or acquisition phase. At that point, this is what we might call an exit. At that point, your investors could be paid off, you yourselves could be paid off, and your company would be well on their way to sustainability. And so, luckily, I've been able to upload our travel brochure into PowerPoint format. And so, first up, we have the convertible note document type. And so, one of the wonderful things about this is that, well, I mean, just to be clear, the convertible note itself, it's basically a loan that the investor will be given to. They'll be saying, like, hey, here is a pile of money, and I want to loan that money to you. At this point, I have no idea what your company is worth. You don't know what your company is worth. It's just way too early to tell. And so we have no upfront pricing. At this point, there won't be an actual valuation set on your company just because it's so early stage. And so at this point, the only guarantee really is that the investor with a convertible note might have a maturity date attached to the loan, right? It would have an interest rate, just like most loans do. And of course, when it comes to the loan itself, this could be transferred into shares. We call it converted into shares at a later date. The deal is that once you do raise venture capital financing, or perhaps you're bought out by a company, at that point, you would have a valuation set for your company. You would have either the armies of lawyers and financial analysts from the VC firm trying to set value for your company. You would have kind of a long history, transaction history of how many users you might have, or how many customers you might have, how much revenue is coming into your business. And so you'd have a much more concrete sense of how much your business is worth. But at this stage, at what we call a seed stage, you're just trying to get your business off the ground. You wouldn't have any of that information yet. And so you still would want to offer certain carrots when it comes to trying to woo investors. Right? And so, of course, there are other ways to sweeten the deal. Right? When it comes to a discount rate or valuation cap, these terms will actually change the conversion rate that the investor would be able to convert at. If, for example, give you a $100,000 loan in the form of this convertible note. Later on, if you raise $1 million if at a later time you have Series A venture capital financing, your company's worth $1 million at that time. At that point, the investor would say, okay, I put in $100,000, and it turns out your company's worth $1 million. $100,000 divided by 10 million, it's about 10% of your company. So therefore, I should be able to convert my loan into 10% of your company. And so the discount rate and valuation cap, they actually tend to sweeten the deal for that early stage investor, because one might say, hey, if the investor gave you $100,000 back when your company is worth a very speculative amount, they might deserve a greater reward for that early risk. And so with the discount rate, they would be able to convert for more shares than their $100,000 originally might have been worth. Same deal for the valuation cap. We can dive into those a bit later as well. Then we have the prepayment term. This has to do with the ability of the company to pay off the loan early, so that the investor can no longer invest. They just get their original investment back, with the original loan back plus interest. But typically, an early stage investor, they really aren't too interested in a 2 to 7% return. They want 10 times, 100 times their money back. And so instead, usually with a convertible note, prepayment is explicitly not allowed. The idea is that the investor would want to make sure that they would be able to convert if you end up raising a boatload of money later on. And then we have these pro rata participation rights. These have to do with the ability of the investor to put on additional money during these subsequent financing rounds, just to maintain their investment. Now, at this point, I'm sure you're thinking this to yourself, Kevin, I've heard about this travel package before. No upfront pricing, that sounds wonderful, but there's got to be a catch, right? And so at this point, there's kind of a situation similar to Pirates of the Caribbean, where you just really you're not really able to understand this unless you've been to capital land before. And this is the topic of liquidation preference overhang. This is something we'll dive into later on as well. But something that's very important to address, this liquidation preference overhang. These other documents, the KISS and SAFE agreements, do address them in the form of what we call a shadow series of stock. But these are very streamlined agreements. When it comes to the KISS, this is acronym for Keep It Simple Security. This is from the 500 Startups Incubator, as well as the SAFE agreement, the Simple Agreement for Future Equity. It's from Y Combinator, two very common convertible equity documents that we've got. And the wonderful thing about these are that they're very streamlined for early stage investors. When it comes to the maturity date, the interest rate, these issues, like I said, most early stage investors don't really care about a 2 to 7% interest 12, 18 months down the line. So the idea is that why bother negotiating over that during the convertible note phase? At that point, might as well just forego them, so that you really get into the discount rate and the valuation cap, which is probably what you do want to consider. As mentioned, very streamlined. In terms of the convertible note, it's about 20 pages. The SAFE and KISS notes really cut that down. And then, as I mentioned, with the shadow series of stock, this allows you to sidestep that issue of liquidation preference overhang, which we will get into at a later time. And then after your convertible note round, after going through perhaps the KISS or SAFE agreements, you would probably have these follow-on rounds of venture capital. These will entail a lot more in terms of the due diligence and just the size of the documents involved. At that point, your entire capital structure of the company will change. Your articles of incorporation, for example, will go from about 2 pages to more like 25 pages. A lot of them having to do with protective provisions, just to make sure that the investor gets the good end of the bargain when it comes to their deal with the entrepreneur. So some of these terms include a pre-money valuation of the company. At that point, you will settle mostly what the value of the company is. You have to agree with the investor what that is. Dealing with option pool sizing, how much of the stock of the company to set aside for enticing, encouraging future employees or contractors, anyone who would receive compensation on an equity basis. Dealing with board seats, of course, dealing with control of the company, also part of the protective provisions for investors, dealing with anti-dilution protections to ensure that the investors themselves, in case something goes wrong within the company in later stage financings, if the valuation of the company goes down, these help keep the investor's investment amount close to where the initial bargaining was. Of course, we have the participating versus non-participating preferred stock. This will have a pretty huge impact on the overall economics of that deal. And so at this point, I've belted a lot of information at you. I want to turn to our live studio audience for their own user stories for going through these trips. I noticed, hey, you there?
Yeah.
Oh, what's your experience been?
Well, I took a trip to Capitaland a few years ago, and it seemed to be going awesome at first, or so I thought. I found an angel investor really quickly, and we both agreed on a low valuation cap. But then the next time when I was trying to get my next series of financing, I couldn't get any investors to bite, and it just ruined the whole trip.
Oh, I see. Yeah, I mean, this sounds like a good time to dive into these terms that would affect that conversion. And so, first of all, we have the discount rate. I know you didn't mention it, but this does tie in somewhat with valuation cap. For the discount rate, it's pretty similar to kind of any kind of sale that you might have in buying clothing or the gadgets. At this point, let's say we had the example of the $100,000 convertible note at a 20% discount rate. Turns out in Series A financing, you find out that the company is worth $1 per share. With a 20% discount rate, the convertible note investor would be allowed to convert their $100,000 at 80 cents per share, rather than the original deal that would have been $1 for each of that $100,000 loan. Right? In this case, they would get more bang for their buck. Similar kind of medium exists with the valuation cap. So at this point, the valuation cap might be set at, let's see, $2.5 million. So $100,000 at a cap of $2.5 million. What will happen is that if, let's say in Series A, at that point the company is worth $5 million. For an investor that has a $2.5 million valuation cap, the largest share price for the company would be calculated based on that cap amount, rather than the actual valuation of the company that was calculated in Series A. So if at Series A, it was found that the company is worth $5 million at $1 per share, that means if they had a cap of $2.5 million, then the shares would be treated as if they're only worth 50 cents per share. So if that note would convert within, at this conversion rate, they'd be able to exchange that loan, that $100,000, for 200,000 shares rather than that 100,000, that 1-to-1 ratio that would have existed before. And I might also note, if there is a discount rate and a valuation cap that is tied to that convertible note, whichever share price is lower will be the controlling factor. And so in your situation, what might have happened is that your valuation cap was so low that follow-on investors would have been pretty wary, just because the convertible note investor could be getting a much better deal than the Series A investors. And so when they buy the same shares, essentially, it could be that, let's say your valuation cap was only at $1 million for that convertible note investor. And at Series A, you still raised at a valuation of $5 million. At that point, your convertible note investor could be converted at 10 cents per share. And so the other investors, for additional reasons on liquidation preference overhang, they might be very scared of that situation. And no investor really wants to be paying 10 times the amount someone else is for the same stock. And so that might have been what happened. But yeah, I'm really sorry that happened to you. It seems like a pretty harrowing situation. What about anyone else?
Oh, me.
Oh, yes, you there.
Yeah, well, I took your advice. I was part of a company that was, really taking off there, and we were doing really well. We were seeing a lot of these destinations, Series A, Series B. Wow, I got my photos from Series B. That was just great. But after a while, though, we sort of slowed down our business model. We couldn't make adjustments and all that, and eventually had to get bought out. And there was about several $100 million that we were bought out for, but I didn't see any of it. So it just spoiled it all. I mean, I don't know what happened.
Oh yeah. Okay. So in that situation, I want to go into the liquidation preference, the topic. Now, just so everyone understands, when it comes to liquidation preference, this is essentially a guaranteed payout for those investors. And so if usually it's going by a multiple. So 1x liquidation preference means that for every dollar that they invest, they're guaranteed $1 back before any of the common stock holders get any share of the profits. And the common stockholders would be the founding team, the employees, essentially everyone who's not an investor. And so if you were to calculate the liquidation preference for a convertible note holder, this is how you do it. Right? In this kind of note, there is no real accounting for that liquidation preference overhang, and we should get into that topic as well. So when it comes to the angel investor from our previous examples, they put in $100,000 and they have that 20% discount rate. It would convert into 125,000 shares. Okay, and that's fine and dandy. But oftentimes the liquidation preference term would only appear in the Series A documents. They wouldn't actually be contained within the convertible note round. And so the fear is that because the liquidation preference is written into the shares of the Series A documents, the Series A investors would have the same treatment as the convertible note investors. And so typically they'd say that for every share value within the Series A round, the investors would get that liquidation preference. And so as a result, the angel investor would receive $125,000 in liquidation preferences because they have 125,000 shares, except they only put in $100,000 to begin with. And that could be fine if you want to encourage and incentivize your early stage investors. But you could see that this could snowball if you have a larger discount rate. A similar fact pattern would apply if there were a valuation cap that was too low. At that point, if the investor gets a lot more shares than what they actually put in terms of their check size, their liquidation preference would far outsize their initial investment. And that's what we refer to as the liquidation preference overhang. And so this also interacts with something else called the participating preferred stock term. What happens in this case is that if the company gets bought out, that's right. The investors, they would receive their investment back from the direct proceeds of the sale before any of the common stockholders get a share of the profits. So in that case, what happens is that when the investor, in the company receives this wonderful news that they've been bought out by $300 million, the investors would come in and say like, oh, we actually invested $250 million of our own money into this. We're gonna take a share of that, and then from there, you have $50 million of profit. That's wonderful. At that point, the investors would convert all of their preferred stock into common stock, and they'd be kumbaya with the other founders, and so you'd all share equally within that $50 million. As a result, early stage employees that might have gotten 1%, 2%, 3% of the company, their ultimate payout check might be a lot smaller than they would otherwise think. Right? Just going through an example here, when it comes to participating preferred stock, if let's say you had a $3 million initial investment round with a $7 million pre-money valuation, a 1x liquidation preference, your company gets sold for $20 million. Wonderful news. At that point, the investors will receive that $3 million back because of that liquidation preference. And then as a result, after receiving that $3 million, they would convert their preferred stock into common stock. And as a result, split the remaining proceeds with the founders and the investors. Now let's contrast that with the non-participating preferred stock situation, where the investors have a choice between whether they get their liquidation preference back or they convert all their shares into common stock and just split the proceeds. In this case, the mathematics work out that the investors would receive more money if they converted all of their shares to common stock. But in this case, they wouldn't double dip, so to speak. Double dip referring to they're taking the liquidation preference back and converting it to common stock to receive a share of the rest of the proceeds. And in terms of the difference, you can see that that delta between the blue and orange bars. So that is the difference. Okay, I lost that. Yeah, yes, that difference in volume, that is the difference of participating preferred stock or non-participating preferred stock. And so in your situation, it sounded like perhaps what happened was that the liquidation preference was set quite high as a multiple perhaps greater than 1x. And maybe they elected to have participating preferred stock, and in order to kind of sweeten the deal for the investors, that was what was required for them to be willing to put in that check. And so, yeah, as you can see, the trip to Capital Land can be quite harrowing and full of pitfalls. But hopefully, this presentation has helped make you smarter and safer travelers along the way. At this point, I'd like to turn it over to the rest of our live studio audience. If there are any questions that anyone might have, or perhaps online, That was a lot of information. And certainly very common topic nowadays in the startup ecosystem and atmosphere.
People have questions. One thing that maybe people have heard about is crowdfunding recently. And can you tell us a little bit about how this plays into crowdfunding? How do they actually get the money from the crowd into the business?
Oh, that's right. And so we should probably distinguish between crowdfunding, equity-based crowdfunding, and just the pre-order of goods. When it comes to the pre-order of goods, that is purely kind of a pre-sale of the goods that you will manufacture and service that you will provide after
Kickstarter.
Yes, Kickstarter and Indiegogo, they have these platforms that you can save or you can crowdfund, you can create this nest egg of money to start up your service or product. And then when it comes to equity-based crowdfunding, often they would actually use a variation of the SAFE agreement. And so at that point, the company also would not have a valuation set for it, but they would have a SAFE agreement stating what is the valuation cap for the equity associated with it, and the crowdfunding portal itself will be able to arrange the logistics of getting the information from each of the funders. One kind of perhaps fearful thing about crowdfunding is that if you go for a crowdfunding portal, you would have a multitude of investors, perhaps hundreds, thousands of investors who invest in your company. For follow-on rounds, it kind of remains to be seen whether larger institutional investors would kind of be scared off about that, because generally within the early stage convertible note rounds or Series A financing rounds, you would have one lead investor with maybe 10, a dozen follow or other investors that are syndicated together, and they would all contribute to a portion of the fund. But ultimately, you'd have one lead investor calling the shots, and it certainly wouldn't number in the hundreds. So managing all these different pieces of equity that are owned by different people, it can be logistically challenging. And a lot of times you'll have shareholder approvals that are required that you'd have to chase down many different equity holders in order to actually get that approval. And so just something to flag there.
Can you explain a little bit about a term sheet? Some people may have
Yes.
encountered something like that. What is a term sheet?
Yeah, sure thing. So the term sheet will, essentially, it'll set up the skeleton of the deal itself. The term sheet, it's, ones I've seen, is probably between 16 and 18 pages, and they would provide a summary of many of these terms. I think I've some slides in the appendix. Okay, where are we going? Yes, all these many terms, and the term sheet itself will provide a summary of all these terms. The actual documents that kick in for these terms themselves is probably maybe 130 pages or so. So instead of having to wade through all of the mechanics of each of those provisions in the 130 pages, the term sheet provides a good starting place for exactly what the investors really want to nail down in terms of, well, importantly, these sections. Right? These are the subjects that are a little less straightforward. Right? When it comes to amount raised, that's the amount you raised. Dividends refers to profit shares throughout the company's life cycle. Generally, when it comes to VC investments, the investors really don't want dividends to be distributed. They want everything to all the profits of the company. Most companies are unprofitable for the first many years of their life. But if there are any profits, they would want them to be reinvested into the company so that you can grow the value of the company for that later financial stage. Pay-to-play provisions, these have to do with an investor having to put in additional money in order to maintain their preferred stock status, right of first refusal and co-sale. These have to do with if anyone wants to sell their shares to someone else. Say I'm a company founder and I decide, I really need to liquidate some of my assets in order to pay for my student loans. If I were to offer the sale of that stock to someone else, I would have to first tell the company, like, hey, I'm thinking about offering these shares to be sold to someone else. does the company want to buy it first? And if the company says, no, our company, we really don't want to buy your shares still, I have to offer a co-sale, meaning that any buyer that I find for my shares, I would have to allow the other shareholders to also sell their shares in a proportional manner, so that I would not be able to dump my shares and run away. We'd all have to be able to run away in order for us to all keep us in the same boat. But yeah, when it comes to pre-money valuation, certainly very heavily negotiated. Liquidation preference and participating preferred stock, you see it can make a huge deal when it comes to the economics of that investment. The anti-dilution provision, this really comes into play when the company receives some valuation at Series A, Series B, at a later stage round, Series C, Series D perhaps, the company actually reduces in value. And this is very scary for everyone involved, but especially scary because if an investor comes in after the company is brought down in value, that investor is paying much less for each share of stock. Okay? And so the existing investors, they're afraid that because that new investor is buying that stock so cheaply, they'd be able to buy up a lot of it. And so that would dilute the amount of shares or amount of the percentage of shares that the previous investors do own. And so the previous investors would have this anti-dilution provision where there is some fun math dealing with the Series A conversion price, or so the conversion price from the previous round and the conversion price of the down round in order to average out the effect of them. And so, as I mentioned, in this case, this company timeline would be worth $1 per share at Series A, worth $2 per share at Series B, and then Series C, the dreaded down round happened, 50 cents per share. At that point, in order to actually calculate this, you'd have a weighted average to figure out what would be the conversion rate for the Series A stockholders, because it would no longer just be the valuation cap or discount rate attached to it. The Series A investors would be able to convert their shares at 1.125, and then they'll figure in these other factors. And similar goes to the Series B investors, where they paid $2 per share, whereas in the Series C investors only paid 50 cents per share. And so they'd be able to even out the dilution when it comes to their investment.
I didn't see a slide on this one, but you referred to vesting stocks. Some people
yes.
wanting to set up vesting arrangements. Can you tell us a little bit about how to do that?
Absolutely. So vesting is super important. When an investor puts in their money to a company, one of the largest fears is that at that point, the founding team, the team that really put it all together and were able to secure that investment, they will go on a trip to Hawaii and never come back. By having a vesting schedule, the investors kind of force the founders into these golden handcuffs, right, in order to stick with the company, meaning that the companies would be able to buy back the shares that the founders own at cost without compensating the founding team, so that they're pretty much locked in to that company. And that's pretty important, especially for an early stage investor, because a lot of times the investors are investing in the team itself. Maybe the product or service isn't fully fleshed out yet, but there's that faith that they will continue improving on and iterating on it in order to increase the value later on. If the founding team just takes off, that's not going to happen. And so standard vesting schedule within the value would be a 4-year vesting schedule with a 1-year cliff, meaning that if anyone leaves within the first 12 months of them receiving stock, the company would be able to buy back all of the stock that they issued to that person. If they worked for 12 months and 1 day, at that point, they would have 25% of their stock fully vested. And so the company would only be able to buy back 75% of the stock that they issued to that person. And then each month after that 12-month period, the stock would vest at a rate of 1/36 of the remaining. So that after 4 years, the worker would have fully vested all of their shares that they were issued. But anytime sooner than that, the company will be able to just grab it back and well, incentivize and compensate other workers who stuck on.
And then there's a way to save money on this by filing an 83B.
Yes, and that is very important. When it comes to the 83B election, that's one of the few irreversible mistakes when it comes to startup law. That's one of the few bells that can't be unrung. So when it comes to the IRS and characterizing income that you receive, essentially anytime you become richer, the IRS wants their pound of flesh. Right? And so when a company issues you stock, the idea is that, oh, perhaps you've gotten richer at that point. However, if the stock is if there's a substantial risk of forfeiture attached to that stock, the idea is that you don't really own that property. It's a similar idea with a loan. If you go to a bank, you get a $100,000 loan, the IRS isn't going to say that you have $100,000 of gain because you have to pay it back. You haven't gotten $100,000 richer. You still have an obligation. Similar kind of thing with stock vesting. The idea is that it's possible for the company to just buy it all back at the same price and you gain nothing. Right? So there's a substantial risk of forfeiture if you leave the company or you get terminated for some reason. But if you file what's called an 83B election, with the IRS within 30 days of the stock purchase agreement. It's very important. The 30-day clock, you can't unwind that clock. No matter how hard you try, no matter how many expensive lawyers you hire, you have to make sure you file that 83B election within 30 days of signing the stock purchase agreement. You would be telling the IRS, like, hey, I want to be taxed on this property right now, even though there is still a substantial risk of forfeiture associated with that stock. The fear is that later on, when the substantial risk of forfeiture is gone, right? If you receive stock for your vesting schedule, 12 months down the line, you will have fully vested in that stock. Let's say at the time of issuance, way back when, a year ago, when you bought the stock, when the company issued you the stock, you would write a check for something like $0.001 per share. And that's a very nominal amount. But 12 months later, your share price could be a whopping 50 cents a share. But the gain on that would be 0.4999 cents per share. And at that point, you could have a gain of hundreds of thousands of dollars for stock that you can't actually sell on the stock market. The company would have a right of first refusal on it. It's going to be very hard to generate that money in order to pay off just the taxes associated with that. You'd have ordinary income tax associated with it. It'd be compensation to you. And at the same time, the company would be liable for withholding for that because it would be compensation provided to you because of your employment. And so the company also might not have the money to pay off all of those. And so it just generates or it increases the cost structure significantly if you don't file that A3B election, which for most startup founders, that's the way to go.
Is it easy to find a lawyer to do all this for you?
Yeah, so once you raise Series A financing, you will have lots of lawyers who are happy to help because you'll have lots of money to pay lawyers' fees. When you're in this early stage, it can be quite difficult. And so this is one of the kind of motivations of our clinic, and we really want to provide this base level of legal information to as many people as we can, just to make sure that entrepreneurs are heading out getting onto their trip to capital land safely without falling into these very common pitfalls that we're seeing over and over again.
Any questions that people might have? Well, thank you very much for joining us today, and we will be here every third Friday, and you should tell us if there are other topics you would like to be looking at. Last time it was we were focusing on entity, weren't we? Or really an overview of legal issues and all that. We've got workshops on intellectual property, hiring, lots of other stuff. So just let us know if there's any particular topics you'd like to cover. And again, we'll do it in 15 minutes for you. Okay, thank you, Kevin.